My name is Garth Mackenzie, and I'm a technical analyst and an ETS strategist with Traders Corner. On this show, we're going to take a look at the speed of this recent drop in the market, which is, by all accounts, the fastest drop that we've ever seen in a bear market history. The first slide shows that this drop of 30% on the US market has taken just 22 days. That is incredibly fast. And for many of us who were around in the 2008 financial market crash, that felt like a very rapid crash. But that time around, the market actually took 250 days to drop 30%. So for this market to have fallen 30% in just 22 days is unprecedented. You'll notice on the attached chart here that there are a number of other fairly rapid declines that have also occurred in the past. But what is notable is that most of those previous drops actually occurred in the 1929 market crash. And again, in the years that followed, in the early 1930s, 1931, 1934, etc., there were a number of fairly rapid drops in the market during that time. The 1987 market crash saw 38 days in order for the market to lose 30%. So what we've seen here is something unprecedented, and certainly the most rapid drop in a market in history. The next chart takes a look at the S&P 500 monthly chart, and that actually also just spells it out nice and clearly there for you. You can see in 2008 how the market took a lot longer to get from its peak to its trough, and how the 30% drop took 250 days to unfold in that case. And obviously, most recently, we've seen the S&P 500 now breaking its primary upward trend of the last 10 years, which marked the bull market. And we've now seen that trend line break to the downside, and we've seen the 30% decline in just 22 days. What's also notable on that chart is the VIX. You'll see that the VIX spiked up above 80 in 2008, and once again in the last week, it's also spiked up above 80. So we've seen the same level of volatility in the market as what we saw in 2008. But it's obviously that this crash has just happened much quicker. The next two slides take a look at two exchange traded funds that I want to keep an eye on. These are exchange traded funds that relate to the VIX, the volatility index. The first one is the VXX. It's a very well-known ETF. It's the iPath S&P 500 VIX short-term futures exchange traded note. And what this thing does is it moves higher when volatility moves higher, and it moves lower when volatility moves lower. So you can see there quite recently that since late February, this ETF has gone up like a rocket. And that is a reflection of the higher level of volatility in the market recently. It has begun to come off the boil now in the last week, and I suspect that in time you'll probably see this ETF beginning to move lower as the volatility level slowly subsides in our market. Now, if you're wanting to trade that and you're actually wanting to take advantage of a decline in volatility looking forward, what you could actually use is an inverse VIX ETF. And the one that I'd look at here is the SVXY. That's the ProShares VIX short-term futures ETF. And what you can see here is that now, whilst volatility has been rising rapidly, the value of this ETF has dropped very sharply. What you would expect now is that volatility normalizes over the months to come. In other words, if volatility moves down from the current elevated levels, then this inverse ETF would actually start to move higher. So that would be one way if you wanted to try and play a subsiding in the volatility in the markets. You could actually use this ETF as a vehicle to do so. It could potentially see some quite nice gains if we see the volatility in the market beginning to subside in the months ahead. That's all I've got time for this time. I'll be back again next week with more ETFs.